Here's a number I want you to sit with for exactly 3 seconds before we do anything else. $1. That is what your bank paid you last year in interest on every $10,000 you had sitting in a traditional savings account. $1 on 10,000. 12 months. $1. Not a typo, not an exaggeration. If your money is sitting in a standard account at Chase, Bank of America, Wells Fargo, or any of the big brick and mortar banks right now, you are earning somewhere between 0.01% and 0.05% APY. The FDIC's own data puts the national average savings account rate at 0.38% as of June 2026. The average is already embarrassingly low, and millions of Americans are earning well below it. Meanwhile, right now, today, in the same rate environment, a person who moved that same $10,000 into the right account is earning between $400 and $500 a year on the same $10,000, with the same FDIC insurance, with the same ability to access their money. That gap between what your bank is paying you and what your money could be earning is not a rounding error. On $50,000, it is the difference between $50 a year and $2,000 a year. On $100,000, it is the difference between $100 and $4,000. And the bank is not going to call you to tell you the gap exists. That phone call is not in their interest. This video is. My name is Ryan. I spend a genuinely unreasonable amount of time reading the rate tables, the Treasury auction results, and the fine print that separates the accounts that work for your money from the ones that work for the institution holding it. If you have cash sitting somewhere right now and you're not completely certain it's in the right place, subscribe and hit that like button, because today we are going through every serious option for parking cash in 2026, what each one actually pays right now, who each one is actually for, and the one mistake that costs people hundreds of dollars a year without ever showing up as a fee on their statement. Let's build the map. The account you're probably in, and why it's working against you. The national average savings account interest rate is 0.38% APY as of June 2026, according to FDIC data. That number is a composite across thousands of banks. It includes the online banks paying competitive rates, which means the big traditional banks are pulling that average down from something even lower. Some traditional banks still pay as low as 0.01% APY on standard savings accounts. The low rates exist because big banks carry high overhead costs and do not need to compete aggressively for your deposits. That last sentence is the whole story. Your deposits are not scarce to them. They have millions of customers and a physical branch on every corner. They don't need to pay you more to keep your money, so they don't. The national average savings rate is low because large traditional banks drag it down. Here is the number that makes this real. A $10,000 balance at 0.01% APY earns about $1 per year. That same balance at a top high-yield savings account earning 4% earns $400 per year. Same FDIC insurance, same federal protections, 400 times more money because you logged into a different website and opened a different account. The traditional savings account is not a neutral choice. It is an active decision to leave money on the table. And in 2026, with 3 serious alternatives available and all of them paying real rates, keeping your emergency fund or your short-term savings at 0.01% is the most expensive financial mistake most Americans are making without realizing it counts as a mistake. High-yield savings accounts. The easiest win in the room. The best high-yield savings accounts in June 2026 offer APYs up to 5.00%, far higher than the national average, helping you grow your money faster with minimal risk. Top accounts typically feature low or no minimum balance requirements and minimal fees. Let's be precise about the landscape right now. Peak Bank offers a high-yield online savings account with a strong 4.01% APY and no monthly fees. Capital One's high-yield savings account earns the same rate on all balances with no minimum deposit requirements and no monthly fees. Varo's high-yield savings account offers 5.00% APY on balances up to $5,000 with no minimum deposit requirement and no monthly fees. PBank Savings offers a 4.40% APY regardless of balance with no minimum deposit requirement and no monthly fees. The Fed's target range remains between 3.50% and 3.75% as of June 2026, following 3 consecutive meetings with no rate change. The next rate announcement is June 17th, 2026. Rates have been drifting slightly downward as the Fed's hiking cycle recedes, but the top HYSA rates are still genuinely competitive. As of June 2026, high-yield savings account rates are trending slightly downward, but the top accounts on the list earn roughly 10 times the national average. Here is what the HYSA is and is not. It is the right home for your emergency fund, the money you need to be able to touch on a Tuesday when something breaks. Liquid. No penalty for withdrawal. FDIC insured up to $250,000, earning a real rate while it waits. It is not the right vehicle if you want to lock in today's rate against future cuts. The HYSA rate is variable. When the Fed cuts again, and the market broadly expects cuts in the back half of 2026, your HYSA rate moves with it. You don't control it. The bank adjusts it, sometimes within days of a Fed announcement, and the account you opened at 4.5% last year might be paying 3.8% next spring without a single email notifying you. If locking in the rate matters more than liquidity, the next 2 options are built for that. Certificates of deposit. Locking in before the cuts come. CD rates have been declining since the Federal Reserve began cutting rates in late 2024. But they continue to offer a guaranteed return on par with many high-yield savings accounts. As of late May 2026, the best CD rates hover between 4.00% and 4.10% for short and mid-term CDs, mostly from online banks and credit unions. As of June 8, 2026, the highest CD rate available is 5.00% APY for 12 months from A+ Federal Credit Union on balances up to $1,000. For more practical deposit sizes, United Fidelity Bank offers 4.15% APY on a 3-month CD with a $1,000 minimum. Bread Financial offers a 9-month CD at 4.15% APY with a $1,500 minimum. Tab Bank offers 4.15% on a 3-year CD and 4.20% on a 5-year CD with a $1,000 minimum. Here is the strategic case for a CD in mid-2026 that most people are not making explicitly enough. Interest rates are likely to decline from here, making it one of the last opportunities in the foreseeable future to secure a high interest rate. If maximizing your interest rate is your goal, consider opting for longer terms to lock in today's favorable rates. That is not spin. That is the rate environment. The Fed has paused. Cuts are expected. When cuts come, HYSA rates fall immediately. CD rates are fixed for the term you chose when you opened the account. A person who locks into a 4.15% 2-year CD today keeps that rate whether the Fed cuts once, twice, or 4 times before 2028. The trade-off is liquidity. Most CDs are FDIC insured, and your money is guaranteed up to $250,000 per account holder. But in most cases, you can't access the funds before the CD matures without paying an early withdrawal penalty. Penalties typically run 90 days of interest for terms under a year and 180 days for longer terms. Break a CD early and you give back several months of the return you were earning. The solution most disciplined savers use is a CD ladder. Split your cash across multiple CDs with staggered maturities. One matures in 6 months, one in a year, one in 2 years. You always have something coming due soon if you need it. You always have something locked at a higher rate if you don't. Treasury securities. The option that has a tax advantage nobody mentions. Here is where treasuries earn their place in this conversation. Not just for the rate, for something more specific. Current U.S. Treasury yields as of mid-2026. The 3-month T-bill yields around 3.70%. The 6-month yields around 3.67%. The 1-year yields around 3.66%. The 2-year yields around 3.76%. The 10-year yields around 4.27%. The 30-year yields around 4.87%. At the short end, T-bills are yielding slightly less than the top HYSAs and CDs, so why would anyone choose them? 2 reasons, and both of them are worth real money depending on where you live. The first is state tax exemption. Interest earned on U.S. Treasury securities is exempt from state and local income taxes completely, which means if you live in California, where the top state income tax rate is 13.3%, or New York or any other high-tax state, a Treasury yielding 3.70% has a tax equivalent yield that is meaningfully higher than that number suggests when compared to an HYSA or CD paying the same gross rate but fully taxable at the state level. The math on a $100,000 Treasury versus $100,000 CD at the same nominal rate for someone in a 10% state tax bracket is not trivial. The Treasury keeps more of its yield in your pocket. The more you earn and the higher your state tax rate, the wider that advantage gets. The second reason is the credit quality ceiling. U.S. Treasuries are backed by the full faith and credit of the federal government. FDIC insurance covers up to $250,000 per account holder, but for someone parking more than $250,000 in cash, Treasuries don't have a coverage limit. The entire balance is government-backed regardless of amount. I-bonds issued from November 2025 through April 2026 earn a composite rate of 4.03%, adjusting every 6 months based on inflation. They aren't liquid for the first 12 months. After that, you can cash them with a 3-month interest penalty if under 5 years. For cash you want inflation protection on and don't need to touch for at least a year, the I-bond is a different kind of insurance than a CD or HYSA provides. The decision framework. Who should be in what right now? Here is the honest version of how to think about this in plain English. If your money is your emergency fund and you need to be able to touch it anytime without penalty, the HYSA is your home. Top rates right now are at 4% to 5%. You have no excuse for earning 0.38%. Open one today. It takes 15 minutes online. The FDIC insurance is identical to your current bank. If your money is cash you won't need for 6 to 24 months and you want to lock in today's rates before the Fed cuts again, a CD ladder is the move. Short end around 4.08% to 4.15%. Stagger the maturities. Let the guaranteed rate do its work regardless of what the Fed does. If you live in a high tax state, you're in a 22% or higher federal bracket, and your cash position exceeds $250,000, or you want pure government backing without FDIC limits, Treasuries belong in this conversation for their tax efficiency and credit quality, even at yields that look slightly lower on paper. And if your money is still sitting in a standard savings account at a big bank earning 0.01 to 0.38%, you are not in a neutral position. You are actively losing ground to inflation every single month. The money is not safe. It is shrinking, just quietly enough that it doesn't feel like a problem until you look at what it would have earned somewhere else. The gap is real. The options are available, the accounts exist, and most of them take 15 minutes and $0 to open. The only thing standing between your cash and the rate it should be earning is information. Now you have it. If this gave you a clearer picture of exactly where your cash should be sitting right now and why, subscribe, because next time we are going inside the one money market fund strategy that lets you earn Treasury level yields with HYSA level liquidity, and most people have never even heard of it. I'll see you in that one.